There is a company almost everyone has heard of, yet very few truly understand. A company that manages $10 trillion in assets, an amount larger than the GDP of every nation on Earth, except the United States and China. It is the largest shareholder in Apple, Microsoft, Amazon, Tesla, ExxonMobil, JP Chase, Pfizer, and nearly every other major American corporation. Its software oversees more than $21 trillion in global assets, quietly shaping how money moves through the financial system. During the 2020 COVID crisis, the Federal Reserve hired this company to purchase assets on its behalf, making it both a market participant and the market's referee at the same time. That company is BlackRock. And if you own stocks through index funds or a retirement plan, BlackRock, not you, votes your shares. Most people believe they own stock. They do not. They own a claim to stock. BlackRock owns the shares and exercises voting power that influences corporate governance, merger decisions, environmental policies, executive compensation, and the strategic direction of the entire American economy. The reality is simple. Individuals may hold financial exposure, but BlackRock holds actual corporate power. This is not a conspiracy theory. It is the architecture of modern markets. BlackRock did not even exist in 1980. Today, it is arguably the most powerful financial institution in world history, surpassing every traditional bank or monopoly, because it does not just manage money, it manages ownership. And ownership in any system is the ultimate form of control. To understand how BlackRock came to dominate global finance, you first need to understand what BlackRock actually is. It is not a bank. Banks take deposits, issue loans, and engage in maturity transformation. BlackRock does none of that. BlackRock is an asset manager. It invests money on behalf of pension funds, sovereign wealth funds, insurers, universities, corporations, and ordinary individuals who buy ETFs. These clients hand BlackRock their money. BlackRock charges a fee anywhere from a few basis points to a couple of % and allocates capital according to their mandates. The scale of this is difficult to comprehend. Managing $10 trillion as of 2024, up from just over $4 trillion a decade earlier, BlackRock grew at a pace unmatched in financial history. To put $10 trillion in perspective, it exceeds the value of all U.S. currency in circulation, both physical and digital. It surpasses the combined GDP of Japan, Germany, and the United Kingdom. It represents 40% of America's entire annual economic output, and BlackRock is only one part of a triad. Vanguard manages $8 trillion. State Street manages Egyptian manages $4 trillion. Together, the big three oversee $22 trillion, roughly the size of the entire U.S. economy. Yet BlackRock is the most aggressive, the most politically engaged, and the most structurally influential. Unlike Vanguard, which is technically owned by its fund holders, BlackRock is a for-profit public corporation with shareholders demanding growth. That distinction drives everything. BlackRock was founded by Larry Fink and 7 partners after Fink. Then a rising bond trader at First Boston made a disastrous bet on mortgage-backed securities and lost the firm $100 million. Fired from his position, he walked away with one critical insight. Risk management is not just important, it is the entire game. If you can understand risk better than everyone else, you can dominate the financial world. So Fink and his team built a risk management system unlike anything that existed at the time. They named it Aladdin. The Asset, Liability, Debt, and Derivative Investment Network. What began as an internal tool evolved into the most powerful financial analytics engine ever created. Today, Aladdin analyzes millions of trades, stress tests portfolios, simulates crises, and guides investment decisions, not only for BlackRock, but also for competitors, governments, and central banks. It is the invisible brain behind the global financial system. BlackRock originally catered exclusively to large institutions, but in 2009, everything changed. BlackRock acquired Barclays Global Investors for $13.5 billion, gaining control of iShares, the world's largest ETF platform. Overnight, BlackRock gained access to millions of retail investors who never personally engage in corporate governance. They simply buy index funds and expect market-matching returns, but inside every ETF is voting power, and that voting power belongs to the asset manager. This is how BlackRock gained unprecedented influence without the public noticing. Today, the iShares S&P 500 ETF alone contains about $400 billion in assets. That translates into millions of shareholder votes. In America's largest corporations, votes cast not by the investors who provide the capital, but by BlackRock executives following internal policies. Across all its funds, BlackRock controls voting rights that shape decisions in every major U.S. company. Most investors have no idea this happens. They think they are passive, but BlackRock is not passive. It votes actively, consistently, and strategically. This power becomes clearer when compared to the great monopolies of history. Standard Oil was the archetype of a monopolistic empire. At its peak, it controlled more than 90% of U.S. refining. Rockefeller owned the production chains from wells to pipelines, to refineries, to distribution. The concentration was visible and overwhelming, and in 1911, the Supreme Court broke it into 34 companies. But Standard Oil's power was confined to one industry. BlackRock's influence spans every industry. While Rockefeller controlled kerosene prices, BlackRock influences corporate policy across airlines, tech firms, pharmaceutical giants, energy producers, banks, retailers, everything. Standard Oil's concentration was tangible. BlackRock's is diversified and therefore legally invisible. There is no law preventing one company from owning pieces of all other companies. J.P. Morgan's Industrial Trust at the turn of the 20th century controlled railroads, electricity, steel, and communications through interlocking directorates. Morgan's personal presence defined the era he sat on boards, appointed CEOs, and hand-picked corporate strategy. The Pujo Committee eventually exposed the extent of his influence, leading to regulatory reforms that banned interlocking directorates. BlackRock learned from that history. It avoids direct control. Fink does not sit on boards. BlackRock does not appoint executives. It does not need to. It simply votes. Its influence is indirect, diffuse, and therefore much harder to regulate. You can outlaw directors serving on multiple boards. You can't outlaw an asset manager from voting shares. It legally controls. The third comparison, Farben, reveals how economic power can become political power. Farben dominated Germany's chemical industry, funded political movements, and shaped national strategy. After the war, It was dismantled because its influence had become inseparable from state interests. BlackRock's influence operates on a global scale, but through legal structures. Larry Fink is an advisor to presidents. Former BlackRock executives staff the U.S. Treasury, the Federal Reserve, and the White House. Its alumni fill key positions in Europe as well. Through Aladdin, its risk models guide decisions made by governments, pension funds, and central banks. When an institution's tools become indispensable, its influence becomes unavoidable. BlackRock does not need to dictate policy. It shapes the terrain on which policy is made. It does not need to explicitly pursue power. Its scale generates power automatically, and while it neither produces oil nor manufactures goods, it owns pieces of the companies that produce everything. That is the essence of financial oligarchy. Control without visibility, influence without accountability, authority without ownership in the traditional sense. A single institution, through a web of ETFs, algorithms, and passive investment flows, has become the quiet backbone of global capitalism. And the deeper its integration, the harder it becomes to unwind. BlackRock does not manufacture chemicals, refine oil, or operate factories. Its influence comes from something far more subtle. It votes shares. And that simple power, when applied across the entire corporate landscape, becomes extremely dangerous. To understand how, we need to break down the 5 mechanisms BlackRock uses to shape markets. These mechanisms are not hidden. They are public, documented features of its business model, yet their implications are profound. The first mechanism is concentrated ownership across nearly every major industry. BlackRock is the first or second largest shareholder in almost all of the S&P 495 out of 500 companies. This ownership is not symbolic. It comes with enormous voting power and strategic leverage. Consider the tech sector. BlackRock owns 6.8% of Apple, roughly $200 billion worth, making it the largest institutional shareholder. It owns 7% of Microsoft, more than $210 billion. It holds 6% from Surat, but for it, 6% of Google's parent company Alphabet, then part of Meta, and nearly that of NVIDIA. These are the companies defining the structure of the global digital economy, and BlackRock has meaningful stakes in all of them. The same pattern extends beyond technology. In banking, BlackRock owns between 12 and 7% of every major institution: JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, Goldman Sachs. In energy, it owns 7.2% of ExxonMobil, 7% of Chevron, and substantial stakes in ConocoPhillips and Occidental Petroleum. Pharmaceutical giants including Pfizer, Johnson & Johnson, Merck, AbbVie, and Bristol-Myers Squibb all have BlackRock as a top shareholder. Consumer goods companies Procter & Gamble, Coca-Cola, PepsiCo, Walmart, Home Depot are no different. Everywhere you look, BlackRock owns between Setwa and But. This pattern is the key. Traditional monopolies dominate one industry. Standard Oil controlled oil. AT&T controlled telecommunications. But BlackRock controls small slices of everything. Its monopoly is not vertical or horizontal. It is systemic. By owning roughly the same percentage of all major corporations, BlackRock creates a monopoly of ownership rather than a monopoly of production. This gives it an advantage no historical monopoly ever possessed. Think of it this way. If you own 7% of Apple and 7% of Microsoft, It does not matter who wins a competitive battle between them. If Apple gains market share, BlackRock's stake appreciates. If Microsoft gains market share, BlackRock wins too. This is true across airlines, banks, grocery chains, drug makers, tech platforms, everywhere. BlackRock's optimal outcome is not competition. It is calm, stable industries that raise prices together, reduce risk, and increase collective profits. The incentive is to depress competitive pressure, because internal competition harms the returns of companies BlackRock holds across the board. This insight underpins what economists call common ownership theory. The idea that when the same shareholders own competitor firms, those firms compete less aggressively, and the evidence supports it. A widely cited 2017 study by Azar, Schmaltz, and Tiku found that airline ticket prices were 32% higher because BlackRock, Vanguard, and State Street owned large stakes in all the major carriers. Airlines simply did not undercut one another as fiercely because their biggest shareholders benefited more when the entire industry kept prices elevated. In banking, similar studies show that financial institutions with common ownership offer lower interest rates to depositors and charge higher rates to borrowers. Why fight for customers when your largest shareholders also own your closest rivals? In pharmaceuticals, common ownership correlates with slower innovation and higher drug prices. Across sector after sector, BlackRock's universal presence distorts incentives and weakens competition, shifting billions from consumers to shareholders. That is the first mechanism, not controlling one company absolutely, but owning meaningful slices of all companies and using that position to shape industry-wide behavior. The second mechanism is proxy voting power and control over corporate governance. When individuals buy ETFs or index funds, they believe they own shares. Legally, they do, but practically, they do not control those shares. Asset managers vote on their behalf, and at BlackRock's scale, this becomes a lever of extraordinary influence. BlackRock votes shares tied to $10 trillion in assets. In 2023, it cast votes at more than 16,000 shareholder meetings. These votes affect board elections, executive compensation, mergers, environmental disclosures, diversity policies, management oversight. Every issue that defines how a corporation behaves. Most retail investors never vote. They do not read proxy statements or track corporate governance. They outsource the responsibility entirely. This leaves a vacuum that BlackRock fills. With 6% to 8% ownership in the largest companies, BlackRock's voting block is typically the biggest single block of votes, larger than any hedge fund, larger than most pension funds, and far more organized than the scattered votes of millions of individuals. Consider ExxonMobil in 2021. A tiny activist fund, No. 1, owned just 0.02% of Exxon functionally nothing. Yet it nominated 3 new board members to push Exxon toward cleaner energy. Exxon's management opposed the effort intensely, but No. 1 won. Why? Because BlackRock, Vanguard, and State Street sided with the activists. BlackRock's vote alone outweighed tens of thousands of individual shareholders. The result? Exxon's leadership was overturned. A company worth hundreds of billions saw its strategy change because one asset manager voted differently. This is how BlackRock shapes corporate America. It does not run companies directly. It controls the composition of boards, and boards control everything else. BlackRock claims it votes strictly in the best interest of its clients, But its clients comprise millions of people and institutions with wildly different interests. Some want SG, some oppose ESG, some want aggressive innovation, some want stable dividends. BlackRock cannot satisfy them all. Instead, it follows its own proxy voting guidelines, shaped by Larry Fink and the stewardship team. Fink's annual letters to CEOs function as de facto policy directives. When Fink declared in 2020 that climate risk is investment risk, he was not making a suggestion. He was signaling how BlackRock would vote. Companies that failed to meet climate disclosure standards found BlackRock voting against their boards. When Fink emphasized racial equity and stakeholder capitalism, companies responded not because they agreed, but because the largest shareholder insisted. This is the subtlety of BlackRock's power. It does not threaten companies. It nudges them. It does not command. It recommends. But everyone knows those recommendations come with the force of trillions behind them. And while each individual vote seems incremental, the cumulative effect is that BlackRock serves as an unofficial regulator of corporate America, one that no voter elects and no law clearly limits. He urged companies to shift their focus away from the old idea that shareholders were the only people who mattered, and instead consider every stakeholder in the system, employees, communities, and even the environmental impact of their operations. In 2022 and 2023, he doubled down on themes like net zero commitments and corporate diversity. He pushed executives to publish their diversity metrics, establish measurable inclusion targets, and treat these issues as core business priorities rather than optional values. These were not government mandates or democratic decisions. These were Larry Fink's personal policy preferences, projected onto the entire corporate landscape. Because BlackRock controls voting rights tied to roughly $10 trillion in assets, Fink's preferences quickly become de facto corporate policy across the United States. Whether you agree or disagree with ESG initiatives is not the point. The point is that one individual unelected, unaccountable to the public, can shape how 500 of America's largest corporations operate simply because he votes on behalf of millions of passive index fund investors who do not even know he is casting ballots for them. This is a soft form of oligarchy, distributed through investment vehicles that most people assume are neutral. Larry Fink now wields more corporate voting power than any individual in American history. He surpasses titans like Rockefeller and J.P. Morgan, not because he personally owns vast industrial empires, but because he votes the assets of ordinary workers, pension holders, and retirees who never explicitly authorized him to shape corporate governance on their behalf. This influence becomes even more consequential when you look at BlackRock's most powerful and least understood instrument, the Aladdin system. Aladdin is a massive software platform designed to analyze risk across investment portfolios. It tracks assets, liabilities, derivatives, and exposures in real time, using sophisticated models to evaluate how different market conditions would affect millions of positions. Built in 1988, the system has grown for more than 3 decades into something like the operating system of global finance. Aladdin now oversees around $21 trillion in assets far beyond BlackRock's own $10 trillion. More than 200 institutional clients license it, including major pension funds such as CalPERS, insurance giants like AIG, sovereign wealth funds, and even rival asset managers. That means Aladdin has visibility into roughly 10 of all the world's financial assets. And the significance of that visibility is not merely that the system tracks risk. It also recommends actions. When Aladdin flags an asset as risky, institutions using the platform are nudged to sell. When it spots opportunity, they are encouraged to buy. And because so many institutions rely on the exact same platform, the recommendations can move markets instantly. If 50 pension funds simultaneously sell a bond because Aladdin labels it dangerous, that bond's price can collapse in minutes. This becomes a form of algorithmic market coordination, not through conspiracy, but through software homogenizing decision-making at a massive scale. The troubling part is that Aladdin itself is a black box. BlackRock does not disclose its internal algorithms or risk evaluation methods. Clients see outputs, not the logic behind them. Yet those hidden algorithms influence or outright direct the deployment of $21 trillion in capital. If Aladdin contains a flaw, a bug, or a miscalibrated risk model, if it instructs dozens or hundreds of institutions to behave identically, could ignite a self-reinforcing crisis. The 2008 crash already showed what happens when the financial world relies on similar risk models. They all failed together. Now imagine a single model dominating everyone, not multiple competing ones. Despite this systemic fragility, Aladdin is immensely profitable. It generates about $1 billion a year for BlackRock from licensing alone. Clients pay for the system even if its recommendations lose them money. BlackRock bears no liability for its influence, making it a remarkably asymmetric business model. Receive revenue for advice, avoid accountability for its consequences. There is an even deeper layer of concern. Aladdin gives BlackRock something close to a systemic, panoramic view of global finance. It can observe trading patterns, capital flows, risk concentrations, and asset allocations across the world. BlackRock insists it separates Aladdin data from its investment decision-making through internal safeguards or Chinese walls. But these walls exist only within the company, without external oversight. The world is simply expected to trust that the firm would never use its godlike visibility to front-run markets. Perhaps BlackRock does not exploit this opportunity, but the capability exists, and in a world where information advantages are everything, that capability alone reshapes the balance of power. BlackRock's influence expands even further through its deep entanglement with government. The firm is not only dominant in markets, it plays an outsized role in policy formation. Former BlackRock executive staff, the Treasury Department, the Federal Reserve, and the White House. Government officials routinely leave public service to take lucrative roles at BlackRock. This revolving door ensures a continuous alignment of interests, though it is often unclear whether government influences BlackRock more or BlackRock influences government more. A vivid example came in 2020 when markets crashed and the Federal Reserve needed to intervene. The Fed is prohibited from buying corporate bonds and ETFs directly, so it hired BlackRock to execute the purchases. BlackRock earned fees to manage these programs and ended up buying corporate bond ETFs, some of which were its own. In effect, BlackRock used federal money to buy BlackRock products, raising their value and benefiting both the company and its clients. It was simultaneously market participant and government contractor, both player and referee. This would constitute an obvious conflict of interest in almost any other sector. The revolving door extends to high-level economic policymakers. Brian Deese, once BlackRock's global head of sustainable investing, became the director of the National Economic Council. Michael Pyle, BlackRock's chief investment strategist, became chief economic advisor to Vice President Kamala Harris. Wally Adeyemo, formerly chief of staff to BlackRock's CEO, became deputy secretary of the UBA as Treasury. These are not peripheral positions. They shape national economic policy that directly intersects with BlackRock's largest investment themes. The reverse direction also. Former top government officials move into BlackRock's leadership. Stanley Fischer, once vice chair of the Federal Reserve, became a senior advisor. Philip Hildebrand, former chairman of the Swiss National Bank, became a vice chairman at the firm. This creates a feedback loop where BlackRock alumni help craft policies that benefit the firm, and the firm in turn recruits policymakers who understand the levers of government. The result is a form of power unprecedented in modern finance. When government intervenes in markets during bailouts, regulatory overhauls, or climate initiatives, BlackRock profits. The firm positions itself as a leader in green investment. Poised to gain from emerging mandates and subsidies, it influences financial regulation in ways that tend to strengthen large asset managers while making it harder for smaller competitors to survive. This is not the crude corruption of the past. It is a 21st century alignment of incentives, expertise, and institutional reach. And layered beneath all of this is BlackRock's ultimate strategic advantage: information asymmetry. It has more data about markets, companies, and global capital flows than any other institution outside intelligence agencies. Aladdin's insight into trillions in assets, combined with BlackRock's own $10 trillion portfolio and its unique access to policymakers, gives it a multi-dimensional informational edge. It often knows what other institutions will buy before they buy it. And in global finance, knowing first is everything. BlackRock understands which sectors are in danger long before the broader market catches on. It can anticipate policy shifts before they become public announcements. This is not insider trading in the narrow legal sense. It is something more subtle and far more powerful: a systemic informational advantage. And in finance, information advantage is indistinguishable from profit. Imagine Aladdin's vast data pool revealing that 30 pension funds plan to sell emerging market bonds next quarter. BlackRock can see that liquidity will drop and prices will fall before a single trade hits the market. With that knowledge, it can position itself accordingly, moving ahead of trillions in collective flows. Nothing about this is technically illegal because the firm is not using confidential corporate data. It is using aggregated systemic flows patterns only visible from a vantage point that no other institution has. Yet the effect is essentially the same as trading on privileged information. BlackRock profits from insights that no retail investor, no hedge fund, and not even most governments can access. These 5 mechanisms: concentrated ownership, proxy voting power, the Aladdin system, government entanglement, and informational asymmetry, interlock to create a form of market control with no historical precedent. Monopolies of the past were enormous but narrow. Standard Oil dominated production and refining. JP Morgan controlled capital and credit. IG Farben controlled an entire industrial sector. But BlackRock's dominance is multidimensional. It touches ownership, governance, risk management, policy design, and data flow across the entire economy. This is not a monopoly over a product or a single market. It is a monopoly over the architecture of modern capitalism itself, and it continues to grow each year. This brings us to the circular ownership problem, a structure so convoluted that it seems almost dystopian. BlackRock is a publicly traded corporation. So, who owns BlackRock? Its largest shareholder is Vanguard, holding nearly 8% of the company. The second largest is BlackRock itself, through employee stock plans and treasury shares around 5%. The third largest is State Street. But the real twist comes when you ask, who owns Vanguard? Vanguard is nominally owned by its fund shareholders, which means millions of ordinary investors. But in practice, Vanguard's biggest holdings are in the same companies that BlackRock invests in. And BlackRock is simultaneously one of the largest shareholders in the companies Vanguard invests in. The system becomes self-referential. Vanguard owns 8% of BlackRock. BlackRock owns 7% of Apple. Vanguard owns 8% of Apple. BlackRock, Vanguard, and State Street are each other's largest shareholders and co-investors across virtually every large company in America. This is circular ownership. A small cluster of asset managers owns each other and everything else. State Street fits the same pattern, with roughly $4 trillion in assets. It is the third pillar of the triad. BlackRock and Vanguard are among State Street's largest shareholders, and State Street holds substantial positions in both firms' funds. Collectively, the three of them own about 20% of every company in the S&P 500. No single firm has majority control, so technically nothing violates antitrust rules. But together, they form what economists call horizontal shareholding. An ownership structure where the same small set of shareholders controls competing firms across an entire industry. In the 20th century, monopoly was defined by concentrated dominance, like a company owning 90% of refining. In the 21st century, the new monopoly is 3 asset managers owning minority stakes in everything, including one another. The outcome is the same. Competition fades, prices rise, and power consolidates. The difference is that the structure remains legal because the control is distributed just enough to evade regulation, yet concentrated enough to shape the entire marketplace. This ownership concentration also becomes political power. BlackRock, Vanguard, and State Street vote around 20% of all shareholder ballots across the economy. They don't need to meet in smoky rooms to align their preferences. They simply follow recommendations from proxy advisory firms like IS and Glass Lewis. When IS endorses a board member or supports a merger, all 3 tend to vote the same way. The result is coordinated control without explicit coordination. Corporate governance steered by a handful of firms that dominate by structural design. Now consider who actually profits from BlackRock's expanding monopoly. First, Larry Fink himself. As CEO and chairman, he has accumulated a net worth exceeding $1 billion. His annual compensation hovers around 25 to 30 million. But his real wealth comes from BlackRock stock. As the company grows, so does his fortune. And BlackRock has grown dramatically because passive index investing has exploded. Money flows into index funds, automatically retirement accounts, pension plans, and 401ks. All channel funds into the same index products. BlackRock collects fees simply by existing. It does not need to outperform, analyze, or innovate in stock selection. It just owns everything and collects its share from an ever-rising tide of passive capital. BlackRock shareholders also profit immensely. If you bought shares in BlackRock under the ticker block in 2010, your investment has risen more than 500%. But the irony is that the biggest beneficiaries are other giant asset managers. Vanguard, State Street, and similar institutions, who are simultaneously BlackRock's competitors and business partners. The oligopoly enriches itself in a loop. Institutional investors, pension funds, retirement accounts, index fund holders also profit, at least superficially. They enjoy diversification, low fees, and exposure to market gains. But their participation comes with hidden costs. By investing in index funds, they inadvertently strengthen the market concentration that harms them as consumers. A person who puts money into an S&P 500 index fund benefits from its returns, yet pays higher prices for airline tickets, pharmaceuticals, and banking services, because the firms they indirectly empower compete less aggressively. It is a strange double life. You profit as an investor, but lose as a consumer. The net effect may be negative for society, even if it is positive for your portfolio. Corporations profit too. CEOs and boards love BlackRock because it is a passive investor that rarely demands operational changes. As long as stock prices rise, BlackRock is satisfied. Except for ESG priorities, where Fink has strong preferences. BlackRock votes for management 95% of the time. It is the ultimate absentee landlord, powerful, silent, and permissive. Executives enjoy greater freedom to maximize their own pay, while facing minimal oversight from their largest shareholders. But who loses? Almost everyone else. Small investors lose because they think they own shares, but they do not own voting rights. BlackRock votes their shares for them, creating a form of neo-feudal finance. Investors hold the economic benefits of property, while BlackRock holds the political control of property. Consumers lose because horizontal shareholding raises prices. Studies show increases of 3 to 7% across many industries. Small businesses lose because they compete with giants financed and stabilized by BlackRock's trillions. Entrepreneurship declines, market concentration rises, and economic dynamism deteriorates. Workers lose because common ownership suppresses wages. When the same shareholders own all major employers in a region, companies avoid bidding against each other for labor. Wages stagnate, while profits soar. In the end, democracy itself loses. Larry Fink's annual letter to CEOs often has more real-world impact than legislation debated in Congress. Corporate policy on climate, diversity, governance, and long-term strategy is quietly shaped by preferences backed by $10 trillion in voting power, without elections, accountability, or transparency. And the public, whose savings empower this empire, rarely realizes that someone else is using their voice. We only learn how BlackRock voted after the decisions are already made, long after the outcomes ripple through the economy. The most powerful force shaping corporate America is accountable to no one. Not voters, not consumers, not the public, only to BlackRock's shareholders, who are themselves mostly other giant asset managers. Capitalism, in theory, is supposed to reward competition, encourage innovation, and allow the best status to rise. But when the same financial giants own stakes in every competitor, competition becomes theater, innovation suffocates, and monopoly profits accumulate in the same small circle. This system is not capitalism. It is something else: corporate socialism for the giants, ruthless competition for the small. A world where BlackRock, Vanguard, and State Street own everything, and everyone else fights for the leftovers. And the system is accelerating. The shift to passive investing continues at a pace no one imagined 20 years ago. In 2000, active mutual funds controlled 90% of assets. Index funds were an afterthought. By 2024, passive funds crossed the 50% threshold, becoming the default investment choice for millions. The momentum is unstoppable. Every year, investors pull billions from active funds and pour them into cheap index funds. Individually, it is rational low fees, reliable returns, no guessing. But collectively, it creates a structural distortion. The more money flows into index funds, the more power BlackRock, Vanguard, and State Street accumulate. The more power they gain, the more influence they have over prices, wages, competition, and corporate governance. And that influence creates an even larger incentive for money to flow to them, a feedback loop with no natural endpoint. By 2030, analysts forecast that index funds could control 70% of you. Equities. At that level, BlackRock, Vanguard, and State Street would collectively hold effective voting control over most major corporations, not through majority stakes, but through coordinated minority ownership. An invisible form of dominance the antitrust laws never contemplated. And the strange part is that no one has the incentive to stop it. Why would an ordinary investor choose a high-fee fund that underperforms when a cheap index fund delivers better returns? The individual logic is flawless. The systemic consequences are catastrophic. BlackRock understands this dynamic perfectly. Larry Fink's annual letters have grown more ambitious, more philosophical, positioning BlackRock not merely as an investor, but as a guiding force for corporate purpose. BlackRock votes on behalf of millions of shareholders who surrendered their rights when they bought passive funds. It is not a conspiracy. It is structural inevitability. As index funds expand, active managers shrink. Only a handful of the largest active firms will survive, which concentrates power further. And when regulation finally arrives, as it always does with monopolies, it will be written with heavy input from BlackRock. The rules will demand transparency, reporting, compliance systems that smaller competitors cannot afford. Regulation becomes a moat, not a restraint. Meanwhile, BlackRock is expanding into private markets, infrastructure, and real assets. As public markets saturate, BlackRock will buy the assets beneath society itself: roads, energy grids, data centers, water systems, housing. The evolution from asset manager to asset owner is already underway. Ownership expands vertically and horizontally until the distinction between public and private blurs, until the entity managing the world's savings also controls the world's foundation. So what can you do in a world where BlackRock owns everything? 3 options. First, accept the system and benefit from it. Buy index funds. Ride the monopoly. Let BlackRock's scale work for you. You are not choosing the system, you are surviving within it. But understand your gains as an investor come at the cost of your power as a citizen and your freedom as a consumer. Option 2. Opt out. Hold individual stocks or invest in active funds that refuse common ownership structures. It is harder, more expensive, and may underperform principled resistance. Almost always costs more, but it avoids feeding the oligopoly. Option 3. Political action. Demand antitrust enforcement. Demand that voting power be returned to individual shareholders. Support leaders who understand the risks of common ownership. It is a long, technical, uphill battle, but the only historical check on monopolies has ever been political will. Standard Oil, AT&T, even Microsoft in the 1990s, all were constrained only because the public eventually understood the stakes. BlackRock is not evil. Larry Fink is not plotting global domination in a dark tower. BlackRock's employees are not conspiring to enslave humanity. They are operating logically within a legal system designed for a different era. The problem is not intent. The problem is structure. A structure where index investing, marketed as democratized finance, has concentrated power on a scale no government, corporation, or empire has ever possessed. A structure where owning 7% of everything is allowed, while owning 91% of one thing is illegal. A structure regulators still do not fully grasp. In 1988, BlackRock did not exist. By 2024, it managed $10 trillion. By 2034, projections show it could control $20 trillion. At that scale, BlackRock would not just be the largest asset manager in history. It would be the most powerful economic institution humanity has ever created. Bigger than any empire, more influential than any central bank. Empires controlled territory and armies. BlackRock controls ownership itself. And in a capitalist world, ownership is the ultimate power. Rockefeller built an oil empire, and it took 4 decades to dismantle. J.P. Morgan built a financial empire that reshaped global banking. BlackRock has built an ownership empire in less than half that time, and it continues to expand. The question now is not whether BlackRock is powerful. The question is whether that power is compatible with capitalism, democracy, and individual freedom. When one company is the largest shareholder in Apple, Microsoft, Amazon, Exxon, J.P. Morgan, Pfizer, and in virtually the entire S&P 500, when one AI system oversees $21 trillion in risk, when one CEO's letter dictates corporate policy across an entire nation. What do you call that? It is not competition. It is not free markets. It is not democracy. It is oligarchy, and the oligarch is BlackRock. If this documentary revealed a system you never realized existed, if you now understand that your stock ownership is symbolic, while BlackRock's ownership is real, then you face a choice. Accept it, opt out of it, or fight it. Every path has consequences, but doing nothing guarantees that BlackRock's $10 trillion becomes $20 trillion, that its 7% becomes 10 trillion, that its influence becomes permanent. BlackRock, the company that owns everything, the monopoly that is legal, the power that is invisible until you learn how to see it. And once you see it, you do not unsee it. Welcome to the world BlackRock built. Population: everyone.